This video is for educational purposes only and should not be considered financial advice. The magic of the new week opening gap. One of ICT's key concepts is the new week opening gap. It helps frame your day trades during that week so that you can have a bias going into each day you place a trade. In this video, we're going to go over 3 ways you can use the new week opening gap to your advantage and increase the probability of your trade success. The main way you can use the new week opening gap is to tell the directional bias for the week. ICT said if price stays above the new week opening gap after Tuesday, it will continue higher. If price stays below the new week opening gap after Tuesday, it will continue lower. Let's take a look at some examples. Here we have a new week opening gap. On a Monday, there's a large gap between the closing price on Friday and the opening price on Monday. Price stays above the new week opening gap during that Monday session, and on Tuesday, it stays above as well. Wednesday comes and price continues to move to the upside. Thursday comes and Friday comes and price stays above that new week opening gap. Here we have a new week opening gap and price goes below it on the Monday, goes back above it, and then on Tuesday it stays above. Now, as we said, ICT mentioned if it stays above on Tuesday, it will continue to the upside. Here is where you have to pay attention to price and its movement. We have liquidity below these 2 equal lows. Wednesday comes and price goes below to grab this liquidity. However, because that move to the downside to grab the liquidity closed below the new week opening gap, that should give you an indication that there may be something else going on. And as we see here, price moved back into the new week opening gap, but then closed outside of it again. That is your cue that price is going to the downside. And as you see, the rest of Wednesday, price continues to go further down to the downside. And then on Thursday and Friday, price continues lower. If price moves away from the new week opening gap, it will likely retrace to it and then take off. One of the ways you can use the new week opening gap is as a possible draw on price for a retracement. If price moves away from the new week opening gap with a large displacement, and you see a swing level form with a large displacement to the opposite side, indicating price may return back to the new week opening gap, then you can be pretty confident that it will. Once it returns to the new week opening gap, it will have a large reaction, giving you an explosive price run. Now, if price has moved a good distance away from the new week opening gap, it may only return back to 50% of the move away and then reverse. Let's take a look at some examples. Here we have a new week opening gap that we saw before. Price moved away from it a good distance and then came back and bounced off of it. However, it did not give you an opportunity to participate in a trade returning back to the new week opening gap. You may have caught one of the trades on the 1-minute chart. But if we pay attention and go back to the previous new week opening gap that occurred here on October 23rd, you can see price moved away and then gave a large displacement. Now you're looking for an entry, but this is during the close of the New York session. So this is not necessarily the best place to enter your trade. So you wait to London, and then you have a New York session occurring here. And that would be a way to enter into a move to the downside, returning back to this new week opening gap. Here we have a new week opening gap. Price moved away from it, and then crosses the 4 EMA here. You could enter there and take price into that new week opening gap. That would be a legitimate trade framed around the new week opening gap. And if we measure it out, it is, you would put your stop loss below the candle and then into the new week opening gap. If you went to the other side, you would get a 2-to-1. We look at Tuesday, there is a large displacement to the downside. Price comes back up, but this is during the end of the New York session, so it's not the best place to take an entry. If we wait until London or even the New York session at 9:30, that is your move to the downside. Now what you're looking for, again, is liquidity taken right here, break of structure that occurs right here. This is the swing low that was broken, a retrace back into fair value gap, then a move to the downside. And that move happened around 8:50. And then price continues down, goes back to the new week opening gap. And if we look at the trade, stop loss of around 30, 28, 2,800 points, and you get 9,400 points to the downside. You can use the previous new week opening gaps as a draw on liquidity as well. Once price has gone past the current new week opening gap, then look for previous new week opening gaps as potential draws on liquidity. Let's take a look at some examples. We've seen with these previous new week opening gaps, they were draws on liquidity. Let's look at this one here that occurs on October 30th. It's a very large new week opening gap. Price moves away from it, then dips into it twice, and then on the Tuesday during the New York session at 9:30, at 9:50, it dips right back into it, creates a wick, and then moves to the upside. Now we'll be looking at the previous week's new week opening gaps as potential draws on liquidity. And as we see on this Wednesday, there's a large move to the upside to this previous new week opening gap. Then it retraces and then moves right back into it to close above it. That is your cue that is reaching for higher prices. Then on the Thursday, it continues higher and you're in a very nice trend on Thursday. And then on Friday, price retraces just a little bit and then takes off to the upside. This is another new week opening gap that's in the future, so disregard that. And then price consolidates, and this is a new week opening gap for this new week coming up. And so when price opens this new week, that's when we draw out our new week opening gap. Price moves away, goes back through it. Then price on Tuesday bounces off of it right before the beginning of the New York session at 7 o'clock a.m. That could frame the basis for a trade. Taking liquidity, bouncing off of a new week opening gap, breaking structure, hitting a breaker, then taking off to the upside during the New York session. Then price continues, and here is where we'll see our return to the 50% of the new week opening gap. If we draw a Fibonacci from this price level where the new week opening gap happens, then we see a return back to the 50% of the distance between this new week opening gap and the high of this impulse. Price reacts strongly from that 50% level on a Wednesday. This is during the end of the New York Open, 12 noon. Then price continues to the upside to take this liquidity, and then it reverses. Here are a couple more trade ideas framed around a new week opening gap. Here's a Friday where you have a previous new week opening gap. occurring up here and the current one occurring down here. During the pre-New York session, price dips down considerably but makes a strong wick. Then price makes an order block right here. But as we see price break structure, we consider this a propulsion block because this is the actual order block. This order block inside this order block is considered a propulsion block. Price breaks structure, returns back to the propulsion block, which happens to occur at the new week opening gap. That would be your entry. As price closes outside of this new week opening gap, it shoots up to the upside. You can also look at this opposite new week opening gap as your trade termination. You want to get out of your trade as soon as you enter into this new week opening gap. There is also another trade that occurs as price retraces towards this new week opening gap and hits in between this liquidity void, which happens also at an order block. As price closes above the order block and above the 4 EMA after hitting the 50% level of this order block and after hitting 50% of this impulse leg, that is another entry to the upside. With this trade, we're looking at the new week opening gap, rejecting price during the London and pre-New York sessions. This creates liquidity that is broken during the beginning of the New York Open. Price retraces back into an order block, then crosses above the 4 EMA. You can enter your trade here. However, if you wait and look at how price reacts off of this new week opening gap, it retraces right back to it. Now, if you did enter your trade here, you can also re-enter with more leverage during this entry of the new week opening gap. Price shoots back up to the upside and gives you a huge risk to reward ratio. The new week opening gap can be a really useful tool in framing your day trades. Make sure you draw it on your charts to be aware of it while you're trading. This will help you to be on the right side of your trade and to not be caught off guard when price shoots off in one direction. If you found this video helpful, please like and subscribe for more videos like these. Also, please leave a comment if you have any questions or if you have other video suggestions. Thank you for watching.